So it's time to, get all the crystal balls out and find out what to expect for Nigeria's economy. We've got a couple of forecasts, come out so far from Central Bank of Nigeria to other investment houses. But today, we're going to drill down on Cardinal Stone's latest outlook for 2026, what they're seeing for the economy, what they're seeing for inflation, the Naira, and other macros right here. Joining me for this conversation, we have Baboye Olaolu, who's the lead economist, fixed income strategist at Cardinal Stone. Great to have you on the show.
Thank you for having me.
Last time I saw you, I'm not sure if it was 2025, but I think it was around then.
Yeah.
It's great to have you again. And, definitely, I know the crystal ball is out right now. You have, churned out what we should expect, this year. We're seeing for nominal GDP 2026 full year about 507 trillion naira. That's about $362 billion. Inflation outlook estimated to fall below the long-run average of 14%. CBN inflation target projected to dip below the 16% target. So it's looking quite good.
Yeah.
So talk to me about what you've seen, what you're expecting so far in 2026.
Okay, first, I think that 2026, or starting from 2025 down to 2026, looks so much like 2019, when we had good stability from macroeconomic perspective, be it growth, inflation, effects. We're gradually moving into that same territory again, right? The pressure that we've seen in the last 3 years, stemming from the reforms that the government did, are kind of waning, and we're beginning to see the benefits. So what we did, for example, was to break down the economic components, looking at the government, the businesses, and the individuals. For example, from the business perspective, if you go back to 2023 and 2024, and you do an average of business profitability using the NGX 30 as a guide, or you decide to look at their performances, what you will see is that quite a number of businesses, especially non-banks, they were reporting material FX losses. A few number of them were in negative, and a few number of them even had their shareholders' position moving into the negative position. But what we're seeing at the moment is that there is a material recovery, both in profitability, FX improvement has led to improved stability for businesses. Now, when you move to the consumer perspective and you try to look at how consumers are fed, what they expect, because of elevated inflation, because of stressed macroeconomic condition that we saw in the last 2 years, right, it weakened consumer wallets. What we're saying now is that there is an improvement in consumer wallets, right? And that is bringing us a bit of confidence for consumers. So generally, the story is looking pretty much great for Nigeria, both from almost all major macroeconomic indicators.
Yeah, and another quite interesting one, some of the multinationals that were reporting that they would leave the country or change their business model with the country. We're seeing some of them starting to have a rethink.
Yeah.
At this point and say, you know what, maybe we can, give this market another try. What are you seeing there?
So most of those businesses that planned to leave, and even those that left, many of them left largely because of FX, right? And because of the stressed macroeconomic condition. Last year, in 2025, FX reported the first gain in over 14 years. And this year, we think that there's leg room for FX to get to about 1,004 levels, right? From the 1,420 plus that we have at the moment, right? And that has supported a few number of businesses to start rethinking, like PZ. And we think that even for more companies, perhaps that we are not hearing in the news, are most likely rethinking Nigeria. From our engagements to foreign investors, both individual investors and corporates, they are bullish on Nigeria even much more than we, the citizen, because this is perhaps one of the best times that you can invest in Nigeria. From a macroeconomic perspective, from a market perspective, everything looks solid and everything looks great.
All right, let's look at monetary and fiscal policy now. Anticipated cumulative cut of about 300 to 400 basis points. I'm thinking that's for the whole of 2026. So
that's correct.
That's quite big. 300, 400 basis points. Short-term yields expected to range between 18 to 20%.
Yeah.
2026 budget deficit forecast at 15 trillion naira. Then oil price benchmark estimated average of $55 per barrel. So much attention on oil right now. We're even seeing pressure right there in the market with President Trump saying, expecting barrels of oil, from Venezuela to the U.S. So talk to me about what you're seeing that will play out when it comes to monetary policy. We only had one cut in 2025.
Yes, that's correct. Yeah, we think that there will be a 300 basis point rate cut next year. For one, inflation
That's this year.
This year,
Yeah.
sorry. Inflation is expected to moderate below the long run average, like you pointed out earlier. One, if you look at what energy prices are saying, we expect energy prices to remain relatively stable, right? The World Bank, the IMF did an analysis on Nigeria, a 40 analysis, to look at the key drivers of Nigeria. And the drivers were put in different buckets. Number one, money supply is the biggest driver of inflation in Nigeria over the last few years, right? More than 50% of inflation driver is influenced by money supply. About 25% is influenced by FX, and then you have an additional 25%, which is influenced by multiplicities of idiosyncratic factors. If you look at the pace of growth in money supply, currently is around slightly above double digits, around 10%, 11%, compared to almost over 40%, 30% that we had about 2 years ago. When you come to FX, which is a major part, FX currently is relatively stable and the outlook is positive. That has supported the downward trend in inflation. Although base effects also accelerated the pace of moderation, the statistical adjustment, that is the CBI rebasing, also aided the pace of moderation. We think that moderation will continue next year. We're going to see inflation below 13%. At current levels of MPR, we think to support the likes of manufacturing businesses and sectors that are sensitive to interest rates that have largely been pressured in the last few years, we think that interest rate at this level is too elevated. So we are looking at about 300 basis point cuts. Most of these cuts will start from our own estimate from May, right, the May meeting, down to the rest meeting of the year. That's where we think that most of these rate cuts will start from. Then from the fiscal side of things, after we did our own analysis, we like the way the whole dynamics is, but we are not too confident from the fiscal side of things. And that's because when you look at what government has estimated in terms of budget deficits for next year, they are projecting around 23 trillion. That is the highest on record. We think that it will not get to that level, similar to what they did last year, where some of the capex for 2025 was moved into 2026. We're likely going to see something similar play out again this year. Capex cuts, capex reduction. We think that they'll be doing a deficit of around 15 trillion, right? And this elevated deficit will mean more borrowings, both in domestic markets and international markets. So we are a bit concerned because debt levels are jumping. If you look at debt levels organically, right, not compared to debt to GDP numbers, debt could move close to 180 trillion by the end of this year. When you look at it on the debt to GDP levels, it's moderating because the GDP is growing faster than debt numbers. But we've said this in the past. GDP don't service your debt. GDP don't pay your debt. You need strong revenue. And debt servicing to revenue is around 60% to 70%, which is still pretty much elevated. So we are a bit concerned in terms of the way the debt levels are jumping, right? But in terms of debt sustainability, if there is risk of debt default, similar to what happened to Ghana and a few other African countries, at the moment, the risk of debt default is very moderate. One, debt to GDP is low. Two, when you look at Nigerian short-term debt as a percentage of the FX reserve, external, right, is over 100% beyond the benchmark that has been set by the IMF. When you look at the duration of the Nigerian state, in terms of the maturity, most of it are majorly short-term debts, medium to long-term debts, which means the risk of a short-term crisis is not there. But we think that government needs to do something fast in terms of the level of debt jumping that we're seeing.
It's quite interesting. We see the likes of Ethiopia exploring a new, debt restructuring, model there where they're not just going to say, oh, forgive us our debts, let's, bench it to the economy. If the economy makes money, you make money. If the economy doesn't make money, then we share the risk. I did read about that, yesterday. But, looking at our forex reserves now, 7-year high.
Yeah.
And I would expect you still see it going higher. That's for the FX reserves there, $45 billion. Do you think, as we're in a pre-election year, at this point, everyone expects volatility, for the Naira. Do you think this is enough buffer for the Naira?
So it's good to point this out before I come to FX reserves. You need to judge what has happened historically. How does the FX and the entire FX market, how do they react during pre-election years? Now, we discovered that since the Nigeria got, since we moved to, we left the military rule and we came to the civilian government. What we've been saying is that FX typically will react more to what the economy is saying, to how the economy is performing, rather than election. If we weigh it on the balance, they will place more emphasis on how the economy is performing. I'll give you an example. In 2019, when we were moving, when we had the 2019 election, right? We had an election during that period. Despite the fact that there was election, we saw Naira being relatively stable. Why? Because that was when the CBN created the I&E window. That led to a more market-reflective exchange rate. Now, what we are seeing at the moment, that's why I said it looks so much like 2019. What we're seeing at the moment is there's a lot of confidence in the FX markets. We saw FPI inflows and even the FDI inflows touch the highest level last year in over so many years, right? Why we're not back at the levels we used to be maybe in 2003, 2004, when we started the heavy reforms that was done by the Obasanjo government. We strongly believe that the investors or foreign flows and the way FX will be a function of how the economy will behave. And you know, during the last election, that was when we had a new president coming. This time, the incumbent power is there. We don't know how the election will turn out, right, with the way the things are. But during the first time that the president is coming in, there's always more volatility compared to the second time, because the general expectation is that if the president is doing well, maybe the president will be able to secure the second term, which is something that might also play out, depending on how the people think and who they want to vote for. But we strongly believe that FX will be stable. We are looking at the reserves getting to $50 billion level by the end of this year. Why? If you look at what the current account numbers are saying, current account surplus at the moment is going to touch $17 billion by the end of last year. We think that we're going to see another $17 billion this year. And that's because we are beginning to see new exports. Gas is there, refined products. Currently, both of them account for close to 45% of oil-related exports. So we think all this will support the FX reserve, boost liquidity, and keep the Naira pretty much stable.
Fantastic. Well, we'll keep exploring, because there's so much, to look out for in 2026. Oh, thank you so much, Baboye Olaolu is a lead economist, fixed income strategist at Cardinal Stone. Thank you for, showing us your crystal ball and what to expect, this year. Thank you so much.
Thanks so much for having me.